Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to talk about two important topics. When the S&P 500 will start recovering and why I'm buying more meta stock. As always, I would like to give you more context first. At the time of making this video, the market is still extremely fearful. The market has been down a lot in recent months, mainly because of President Donald Trump's trade war. Donald Trump has been imposing high tariffs and reciprocal tariffs on its major trading partners, including Canada, Mexico, China, and even the EU. As a result, the market is concerned that Trump's trade war and high tariffs may lead the US into a recession or even stagflation. Stagflation means high inflation, high unemployment, and slow economic growth. This would be the worst case scenario. At the time of writing this script, the S&P 500 is down about 10% from its recent peak. By definition, this is a market correction. In comparison, the tech-heavy Nasdaq 100 is down even more. The Nasdaq 100 QQQ ETF is down around 13% from its recent peak. Meta is down even more at around 22% from its recent peak. Many tech stocks are oversold and undervalued now because investors have been selling many tech stocks, switching to more cash and bonds, and switching their investments from US stocks to more European stocks or even Chinese stocks. This does not make sense at all. The US still has the strongest economy, the most profitable companies, and the best innovations. Many S&P 500 companies, especially the mega cap tech companies, are still expected to report higher earnings this year, even though their growth rates will likely be lower because of Trump's trade war. I always say this, in the short term, the market is a voting machine. This means the market is always determined by market sentiment in the short term. However, in the long term, the market is a weighing machine. This means stocks are mainly driven by business fundamentals and earnings growth in the long run. So in this video, I will talk about when the S&P 500 will likely start recovering and why I am buying more meta stock during this market correction. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing. So you will know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So here's the important question. When will the market or the S&P 500 start recovering? This is my prediction. I believe the best case scenario is that the market will start recovering in the second half of this year, once Trump reaches new trading agreements with trading partners. Based on my understanding, the current market correction seems to already price in a US recession in the upcoming months. If the US does not head into a recession, then the S&P 500 will likely start recovering by the second half of this year. However, if this trade war lasts longer than expected, then I would expect the market to start recovering sometime next year. This is based on my experience investing for more than 15 years. Typically, most market corrections take at least several months to 1 or 2 years to recover. As long as the US is not heading into a recession or stagflation, the market should not take more than 1 year to start recovering. I believe the Consumer Sentiment Index is one of the best indicators that suggests when the market is likely near the bottom. According to the latest Consumer Sentiment Index, consumer sentiment has reached the lowest level since November 2022. As you may remember, the last bear market bottomed in October 2022. Typically, when the market is near the bottom, consumer sentiment tends to be exceptionally low because people don't want to spend money to buy expensive items when they're losing money in the market. So based on the latest consumer sentiment index, I believe we're close to the bottom. In terms of valuation, many S&P 500 companies, especially the mega cap tech companies, are undervalued or oversold now. This S&P 500 valuation chart shows when the market is likely overvalued and when the market is likely undervalued. The red area shows when the market is very greedy or overvalued. The green area shows when the market is undervalued or oversold. Looking back, it's always more clear. The S&P 500 was overbought and very greedy from October to December last year because of the Trump rally. Many investors were speculating and overhyping stocks that would benefit from Trump's policies the most. As of now, the S&P 500 is mostly oversold and undervalued because of the Trump trade war and investors' extreme fear. During a market correction, one of the best things we can do is to look at the market over the long term. History often teaches us many important investing lessons. Since 1870, the US has gone through many market corrections, many bear markets, several major wars, and many economic crises. The market, as represented by the S&P 500, always grows much more over the long run, despite all these major corrections, bear markets, and economic crises. If we compare the current trade war to the past, the current market correction is not as bad as the bear market in 2002 and other bear markets. As a long-term investor and a perma bull, I believe the best approach is to continue buying and holding high-quality companies, buying the dip, dollar cost averaging, and patiently waiting for the market to recover. The S&P 500 will always recover and reach new highs in the long run because of the US long-term economic growth. Now, what about the worst case scenario? I believe heading to a bear market is the worst case scenario. Currently, we're not in a bear market yet. We're experiencing a market correction. A market correction is defined as a decline of 10% to 20% from a recent peak. And a bear market happens when the market drops by 20% or more. Historically, since 1956, the average bear market has lasted about 1 year and 2 months. In contrast, bull markets tend to last much longer than bear markets. This is why I believe the market will start to recover in the second half of this year or by next year if the trade war continues longer than expected. Now let's talk about Meta. I'm going to explain Meta's long-term growth prospects, Meta stock valuation, and why I am taking advantage of this market correction to buy more Meta stock. First, I want to show you this investing app. This is a preview. Right now, I'm building this investing app with a friend. Our goal is to create the best investing application that will help investors find the best stocks for long-term investing. Our investing app will be out this year once we fix all the bugs and improve the UI much more. At the time of making this video, we have calculated Meta's fair value to be around $690 per share. Meta's forward PE is around 23. This is much lower than most S&P 500 companies' forward PEs, even though Meta's EPS is expected to grow in the mid-teens annually over the next several years. I believe this suggests that Meta is likely undervalued now. My investing strategy is to keep investing in the best companies that have the strongest fundamentals, wide economic moats, great products and services, great management, growing earnings, and increasing free cash flows over time. Then I like to keep buying their shares over time whenever the stock is undervalued. I believe Meta is one of the best tech companies for long-term investing. Here's why. First, Meta has exceptionally strong fundamentals with consistent earnings and free cash flow growth over the years. The company has faced many major headwinds such as increasing competition from TikTok and Snapchat. You may recall this not too long ago. Meta was greatly impacted by Apple's app tracking change, which requires users to give Meta permission to track their activities across different apps and websites for advertising and data sharing purposes. Of course, most people would not want Meta to track their activities across third-party apps and websites. So despite all these major headwinds, Meta has achieved consistent revenue growth, operating income growth, and free cash flow growth in most years over the past 10 years, even during the pandemic when inflation and interest rates were exceptionally high. I believe this shows that Meta has a huge economic moat and is the best and most profitable social media business. Meta is also not as cyclical as most other businesses. Second, Meta has exceptionally strong financials. For example, according to the most recent financials, Meta's TTM free cash flow reached $54 billion, which is one of the highest in the US. Meta's current free cash flow yield is at around 3.7%. Meta has 78 billion in cash equivalents. In comparison, it has around 49 billion in total debt. This means Meta can pay off all its debt in advance and still have around 29 billion in cash left. Meta's margins are also exceptionally high. For example, at the time making this video, its operating margin is around 42%, and its free cash flow margin is around 33%. Third, we have to look at Meta's forward revenue and earnings growth over the next several years. According to this consensus forecast, Meta's revenue is expected to grow in the low teens to mid-teens annually over the next 5 years. Meta will continue cutting its operating expenses and improving its margins. This means Meta's EPS will likely grow faster than its revenue growth over the next 5 years. And fourth, we have to look at Meta's family of apps, which is Meta's most important business. I believe Meta has a huge economic moat known as network effects. Meta's Facebook, Instagram, WhatsApp, and Messenger are already the most popular social media apps in the world. At the time of making this video, Meta already has more than 3.35 billion daily active users using these social media apps, and the number has been growing almost every quarter. Outside of China, only TikTok, YouTube, and WeChat can compete with Meta's Facebook, Instagram, WhatsApp, and Messenger apps. Once you use Meta's social media apps, it's very hard to leave them because most of your friends and colleagues use them almost daily. If you stop using Meta's Facebook, Instagram, WhatsApp, and Messenger, you will need to replace them with other social media apps such as TikTok, Snapchat, or X. However, the biggest issue is that your friends and colleagues may not use other social media apps outside of Meta. This means you're likely stuck using Facebook, Instagram, WhatsApp, or Messenger. Meta cannot easily acquire other social media apps like before because of antitrust issues. However, whenever there's a major competitor such as TikTok, Snapchat, or X, Meta often responds by creating similar social media apps and features and then improving on them. For example, Meta copied Snapchat and created Instagram stories. Reels was Meta's answer to TikTok's short-form videos, and Meta launched Threads to compete with Elon Musk's X platform. Interestingly, this strategy has been working very well for Meta over the years. Over the long term, I believe Meta has several major growth drivers. First, I believe Meta's daily active users will continue to grow at low single digits almost every year because of the network effects I talked about earlier. As I mentioned earlier, Meta already has around 3.35 billion daily active users. This is one of the most in the world. Only YouTube has as many daily active users as Meta's apps. As more people use Facebook, Instagram, WhatsApp, and Messenger, Meta will attract a greater number of active users, as well as more content from both users and content creators. At the same time, advertisers will continue investing in Meta's advertising platform because Meta has a lot more users than other platforms. This is known as network effects. Second, I believe Meta's average revenue per user will continue to grow over time because Meta will continue to improve its algorithms, ad ranking systems, and recommendation systems. These improvements will drive better user engagement, better content, and more relevant ads. Many investors do not know this. Meta's content recommendation and its advertising business have improved a lot over the past several years because Meta has been using AI to improve its ad ranking and content recommendation. Meta has been investing in NVIDIA's AI GPUs to improve its ad ranking systems, content recommendation systems, and now Meta AI. Third, if you look at Meta's average price per ad, you may notice that Meta's average price per ad has been increasing steadily over time. This shows that there's a strong demand for Meta ads. Advertisers have been getting higher ROI on Meta's advertising platform. This is why they're willing to pay more for Meta's ads. And fourth, Meta has been cutting its operating expenses, letting go employees they don't need, and shifting more investments to more important projects such as Meta AI and better recommendation systems and ad ranking systems. Meta will continue this cost-cutting strategy because it will improve Meta's margins and free cash flows much more over time. Of course, no company is perfect. Every company has headwinds and risks to consider. As you may already know, Meta has two main businesses: advertising, which is its social media business, and Reality Labs, which is its VR and mixed reality headset business. Meta's social media business has been contributing more than 96% of the company's total revenue and 100% of the company's operating income for many years. In comparison, the Reality Labs business has been losing billions of dollars every quarter since Meta acquired this business. This trend will continue for many years because social media is still Meta's most important business. VR headsets and mixed reality headsets are niche markets. Meta needs to sell hundreds of millions of Meta Quest headsets before this business can break even. Mark Zuckerberg does not want Meta to be controlled by Apple and Google's ecosystems. This is why Mark Zuckerberg is willing to bet a large amount of money on Reality Labs every year, because AR glasses will likely become the next computing platform after the iPhone. This Reality Labs business is essentially a moonshot investment for Meta. Other than Reality Labs, one of the biggest concerns is that Meta is planning to increase its capex much more this year to support the company's AI services and its core social media business. Meta's management said this: "We anticipate our full year 2025 capital expenditures will be in the range of 60 to 65 billion. We expect capital expenditures growth in 2025 will be driven by increased investment to support both our generative AI efforts and core business. The majority of our capital expenditures in 2025 will continue to be directed to our core business." For comparison, Meta spent 39 billion in capex last year and plans to spend approximately 63 billion this year. A large percentage of this capex will be spent on AI infrastructure to support Meta AI, open source Llama models, and other generative AI services. Meta is also spending a lot of money on IT infrastructure to support its core social media business. Meta isn't the only company planning to increase capex this year. Google, Microsoft, and Amazon are also ramping up their capex to build our AI infrastructure, both to meet growing customer demand for AI and to support their own internal workloads. Also, all of them are racing to build the next frontier AI models, such as reasoning LLMs and agentic AI models. They know that they have to invest in AI infrastructure and frontier AI models because they don't want to be left behind. Now, Meta is different from Google, Amazon, and Microsoft's cloud services. Meta does not rent out its AI GPUs, storage, and networking to customers. Meta also does not host third-party LLMs for customers to use, like the hyperscale cloud providers. This means Meta is not earning revenues directly from its AI investments and its open source Llama models. Meta's goal is to build the leading AI system using Llama, develop the most popular open source foundation LLMs, such as the upcoming Llama 4, and grow Meta AI to over 1 billion users before monetizing it. Of course, this means Meta will continue to increase its AI capex over the coming years. Let's consider this. Mark Zuckerberg wants to build mixed reality headsets and eventually AR glasses for the masses, which will be the next computing platform after the iPhone. He also wants to grow Meta AI to over 1 billion active users before starting to monetize it. Personally, I will not bet against Mark Zuckerberg's goals. He has a strong track record of building great businesses, scaling them to billions of users, creating large network effects around them, and monetizing his businesses afterward. Let me show you this consensus forecast from Seeking Alpha. Meta's revenue is expected to grow in the low teens to mid-teens over the next several years. I believe these growth rates are reasonable based on the long-term growth drivers I talked about earlier. However, if Meta AI becomes successful and if Meta starts monetizing it, these revenue growth rates should be slightly higher over the next several years. In terms of EPS forecast, Meta's EPS is expected to grow slightly faster than its revenue over the next several years because the company is planning to reduce expenses and grow operating expenses at a slower pace than revenue growth. Let's take a look at Meta's valuation. Based on these 4 P's, Meta is slightly undervalued now. For example, Meta's forward PE is expected to be around 23 this year. Next year, Meta's forward PE is expected to be around 20. In fact, these 4 P's are lower than many other S&P 500 companies' forward P's, even though Meta has higher forward growth rates than most S&P 500 companies. Let me show you this fair valuation too. This is a preview. The orange line is Meta's fair value. The blue line is Meta's share price. These dotted lines are price targets. At the time of making this video, Meta is well below its fair value line. Meta's fair value should be around $690 per share. In comparison, analysts' average price target is around $713 per share. Our price target is much more conservative at around $584 per share. This means I believe Meta is likely undervalued now. I also calculated Meta's intrinsic value using this intrinsic value model. I always use this intrinsic value model to calculate each stock's intrinsic value, so I would know when a stock is likely undervalued, fairly valued, or overvalued. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Meta's intrinsic value as its future free cash flows discounted to the present day. I use the discount rate of 10.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the expected growth rates and the long-term growth drivers I talked about earlier, I believe Meta's revenue will grow at a compound annual growth rate or CAGR between 10% and 15% over the next several years. My base case scenario is that Meta's revenue will grow at a CAGR of 12.5% annually over the next several years. I used a long-term growth rate of 7% to calculate the terminal value. If you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Over the next several years, I'm assuming Meta's free cash flow margin will stay at around 30%. This is slightly lower than last year's free cash flow margin. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that Meta's revenue will grow at a CAGR of 10% each year over the next several years. Then Meta's intrinsic value should be around $1.7 trillion for the entire company, or $662 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that Meta's revenue will grow at a CAGR of 12.5% each year over the next several years. Then Meta's intrinsic value should be around $1.9 trillion for the entire company, or $736 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that Meta's revenue will grow at a CAGR of 15% each year over the next several years. Then Meta's intrinsic value should be around $2.1 trillion for the entire company, or $817 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Meta's intrinsic value should be around $738 per share. I also use the forward sales valuation model to estimate Meta's intrinsic value, which should be around $1.56 trillion for the entire company, or around $600 per share. If we take the average of both valuation models, I believe Meta's intrinsic value should be around $669 per share. Just to compare, Morningstar has given Meta a much higher fair value of $770 per share. This means I believe Meta is likely undervalued now. So will I buy Meta stock? My answer is yes. I plan to continue buying more Meta shares over time because I believe it's one of the best tech companies for long-term investing. I already hold Meta in this account. I bought back Meta when its market cap was just right under $1 trillion. I also have more Meta shares in other accounts. I will continue buying more Meta stock over time because I like Meta's social media business and its large economic moat known as network effects. I believe Meta's daily active users and average revenue per user will continue to grow over time. Also, Meta will continue cutting costs. This will improve its margins. This means Meta will likely earn much higher revenue, operating income, free cash flow, and EPS over time. This is my prediction. I believe the market will start recovering in the second half of this year once Donald Trump reaches new trading agreements with its trading partners. However, if this trade war lasts longer than expected, I would expect the market to start recovering sometime next year. Now, all these are only my opinions and my analysis that's based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.